Hey guys, welcome back to the Value Investor Show. Today I want to talk through Adobe. Adobe's valuation makes no longer sense. Wall Street has been selling, and I believe this is the most misunderstood company with an actual moat in the world. So for today, I want to talk you through Adobe's performance. Secondly, the fundamentals of the company, the financials of the company, what the company is actually doing, the valuation, and where the stock goes from here, in my opinion, as well as the bear, base, and bull case scenario for Adobe. But before I do, just hear me out for 25 seconds. I'm trying to get it to 4,000 subscribers by the end of the year. I want to thank you so much for watching my videos. It does take so much time and effort putting these videos for you guys for free, but actually 60% of you are yet to subscribe. So if you're new here, if you're not subscribed, just hit the subscribe button because I am trying to get into 4,000 subscribers. Thank you, and let's dive right into the video. So Adobe is down 34% the last 5 years, and it's also down 52% from its all-time high back in 2021, while also revenues actually almost doubled since 2021. And also another staggering part is that the P ratio of Adobe currently is just under 20, and Adobe is forecasted to have an EPS of 23.36 by 2026. That means the forward year plus one P ratio of Adobe is a staggering 13 PE. And this company is way undervalued, in my opinion, based on the current growth expectation. It could be argued that the company currently has a large stock-based compensation as well, which in theory should add up to that EPS, and in theory it should mean that the company is not being valued correctly. But we are going to cover everything about the stock-based compensation of this company right in a few minutes. Now, in terms of market share, according to Bloomberg Intelligence, in 2024, Adobe held over 70% of the creative software market, with its applications firmly embedded in the daily workflows of professional users. Despite this strong market position, the company has faced some competition from Canva, from Figma, and many other AI-driven startups focused on generative content tools, which have created a lot of uncertainty, a lot of fear about Adobe. But we will unravel everything, and I will firmly explain why I think Adobe could be the next Google. We had the same scenario with Google earlier this year. Everyone was saying that, LLMs and AI-driven startups will replace Google as the search engine, and yet here we are. Google is the second most valued company in the world right now. Now, in terms of the revenue mix for Adobe, Adobe is primarily based upon three different product lines. The first one is digital media, which is the largest part of Adobe. It's roughly 74% of revenues, and this segment revolves around two offerings: Adobe's Creative Cloud and Adobe's Document Cloud, which is, for example, your Adobe Photoshop, your Adobe Premiere Pro, among other applications. And customers use these tools for content creation, photo editing, designing, video, etc. So this is the largest part of the revenue stream for Adobe. The second one is digital experience segment, which is roughly 25% of current revenues, and it offers Adobe's experience platform for customer experience management through Adobe's Experience Cloud, which allows basically businesses to transform their customer data into detailed, actionable profiles, enabling organizations to create, manage, and monetize personalized customer experiences. So this segment is primarily based upon businesses only, while the first one was businesses as well as your normal consumers, like individuals like me, like someone else who uses Adobe's products to edit videos, pictures, etc. And the third and smallest one is publishing and advertising, which consists of Adobe's legacy products and services in an end-to-end demand-side platform that enables managing advertising across various digital formats. Again, this is more of a business revenue segment, but it could vary. But in a nutshell, if we look at consumer segments from the annual statements, you'll soon realize that Adobe has two main customer segments. And the first one is businesses. If that's SMEs, small companies, or big companies that use Adobe's products, Or the second segment is individuals, people like me, like you, that use Adobe's products. And actually, the biggest part is via businesses. Businesses make up 90% of that revenue, while individuals make 10%. And individuals are those that usually argue that they're better alternatives or that Adobe's products are way expensive, while businesses are actually the sticky part of the business. But we'll unravel everything in just a few minutes. Before we do, I want to go through the financials, because honestly, Adobe is a monster. If we look at historical revenue and net income, it really has been nothing short of extraordinary. If we look at revenue and net income from 2005 up to 2025, we see an upward trend. Total revenues increased at a CAGR growth of 14%. Net income also increased at a CAGR growth of 14% as well. And as you can see, on a year-by-year basis, we see that overall Adobe has been extremely healthy, and it has been growing revenue while maintaining amazing margins, net income margins. And I think this is evident from this chart. Now, before we go into the rest of the financials, I want to tell you about this massive opportunity you can now get with the Black Friday sale with my link, 13% of Fiscal AI for the next 48 hours. So if you want to use Fiscal AI to check any company that you want, you have to click on my link right now with the next 48 hours and get the solution, because honestly, it's the best data platform for stocks on the market right now, and I would 100% recommend it for people who are just starting as well as more experienced stock investors. Now, Adobe is also returning aggressively to shareholders through buybacks. It's literally a cash cow returning cash. As you can see, here we have in red the total shares outstanding. And year by year, Adobe has been decreasing its shares outstanding. And especially more so the last 3 years, where the stock has been heavily hit since AI first came into the picture, since AI became an existential threat according to Wall Street for this company. This company has aggressively been buying more shares. We're talking, they went from buying around 1% of the company every year to up to 5% last year. Now, free cash flow is also growing, with the company trading at a 6% free cash flow yield currently. As you can see, free cash flow has also been exponentially increasing, especially over the last decade. And also the percentage change of free cash flow has also been growing quite drastically the last 3 years. Now, Adobe is a capital efficiency machine. Its return on equity, its assets and invested capital is growing, and it's at very high levels. We're talking 27%, 43%, 54%, and even more than 100% for the return on total capital. We're talking about an extremely healthy, high margin business that is able to raise prices and yet still maintain its consumer base. Now, revenue is expected to grow, and according to Fiscal AI, according to the expectations of Wall Street, revenue is expected to grow at roughly a rate of 9 to 10% up until August 2026. So the company is still growing, but at a lower rate than historical, which has been, as we have said, around 14%, so around 12 to 15%. Also, in terms of earnings, as you guys can see, Wall Street also expects earnings to increase, but again, at a lower level at around 12, and as we can see, 9%, 9.7%, 9.6%. So earnings are expected to increase at a very similar level to revenue. So it is estimated that the company will remain margins and will keep margins consistent and grow at the same levels. Now, what is the actual bear case of Adobe, and what does it actually mean? And I think there are two ways to look at this. Firstly, the demand side as well as the supply side. So on the demand side perspective, there are three main risks in my opinion. The first one is the structural risk, which is the AI disruption. The AI bear case has been that AI is eating software. We've heard about it. We've heard about it for Google as well. The narrative is basically that just like IT hardware was disrupted by cloud in the 2000s, AI could disrupt software as a service companies. Anyone from startups to big tech can build competitive apps quickly with AI. The implication is that that undermines Adobe's moat, which is the subscription model no longer being unique, that there is a risk of long-term structural decline in relevance as more applications come through that are able to essentially create the pictures, the videos, anything that you like, just simply by a prompt. Now, the second risk is the demand risk, the seed growth and consolidation. Essentially, what this is saying is that even if Adobe is to maintain, the market share, AI tools will essentially reduce the need for large seat counts across sales, across marketing, creative, and HR departments, and early signs that AI may consolidate seats rather than expand them. So basically, this narrative is saying that big companies actually don't need, for example, 100 people that use Adobe's applications. They could need 20 people that do the exact same job with the use of AI. So growth will slow down or reverse in Adobe's core user base, which means fewer paid licenses and therefore revenue pressure. Now, in my opinion, this is far-fetched. I think that, AI should act as a productivity engine rather than, destroying jobs, at least not for the next, 5, 6, 7 years. But this is another narrative that has been on the spotlight for a very long time. And the third one is competitive risk. There's new entrants and big tech, and we have seen Figma, we have seen Canva, Runaway as well, rising with strong funding, maybe faster innovation or different innovation, as well as big cloud players like Google, Microsoft leveraging AI, compute to scale to build free cheap creative tools like Banana, like Google's new Banana model. And younger demographics may opt out Adobe entirely, which means market share erosion, especially in creative suite, pricing power weakens as substitutes multiply. But as I said, only 10% of revenue from Adobe is actually from individuals. So this thesis, this narrative would only apply to the 10% of Adobe's revenue. Now, the valuation side is that there is financial risk in terms of the stock option dilution. So the company currently has a lot of stock options currently involved with the valuation. So the current reported NTMP ratio is 15.6. But if stock options were treated as a real expense, the EPS would fall at a true multiple of 19.6. So that means that the current P ratio is actually higher than it's supposed to be because of that stock option not being treated as a real expense. But software as a service companies tend to have a lot of stock options, and actually other companies like Salesforce have a much worse dilution than Adobe. Also keep in mind that Adobe is buying a lot of shares back and therefore is mitigating the stock options as much as they can. Now, Adobe looks more expensive than headline numbers suggest, and therefore investors could punish valuation further, as I just said. And the second risk here from the valuation side is the downside to the PE, the valuation risk, because with the stock options and if the growth slows down to 0%, PE could compress to single digits like hardware firms during the cloud disruption, which could potentially severely multiply compression and stock price downside risk. Of course, these are both, in my opinion, quite far-fetched, but it's still valid risks. Now let's look at the stock-based compensation because I have flagged it. In an ideal world, no one actually does this, but in an ideal world, they should be considered as an expense to the business. And as you can see, the stock-based compensation expense in millions have increased over the years. Since 2010, the stock-based compensation was 231 million, and in 2024, it now went to 1.8 billion. This is a major non-cash expense, but as I said, the company is just buying stocks aggressively. It has a huge share buyback program, and therefore it is mitigating the stock-based compensation expense as much as they can by buying back shares. Now, the bull case of Adobe is the following, and it's actually the inverse of the risks. And why I say that is because AI products could become the groundbreaking innovation, the catalyst for Adobe in their ability to create the most innovative and the most used product in the market. The launch of Acrobat AI Assistant, Firefly app, and Gen Studio are creating a very high margin subscription-based revenue stream, and is already on track to surpass the 250 million in new AI ARR this fiscal year. This proves that there's actually traction in the AI monetization strategy. This strengthens Adobe's position as an innovation leader, and it supports recurring high margin growth. Also, the expansion of customer universe. So Firefly and Adobe Express open new doors to new consumer segments who previously found Adobe's tools too advanced or maybe even too expensive. And AI simplifies those workflows and lowers barriers of entry. And what I mean by that is, because of AI, it's easier to use Adobe's products because you have an AI assistant guiding you through the way. And this expands Adobe's total addressable market. It creates an on-ramp for millions of new users, and it actually diversifies revenue beyond the professionals that make 90% of the current revenue. And the third pillar is the enterprise content supply chain, because with Gen Studio and Firefly integrated with Adobe's analytics and marketing stacks, it does provide enterprises with an end-to-end content creation, management, and personalization platform. It solves a critical enterprise pain point, it strengthens the enterprise stickiness, and creates a deep integration across Adobe's ecosystem, boosting cross-sell and retention. AI, in my opinion, is a catalyst for Adobe. In fact, if you look at Adobe's YouTube channel, if you look at Adobe's website, they have been posting about AI all along. They do believe that AI is the foundation, is the catalyst to allow more growth, higher margins for this business. I mean, look at this. The last 8 videos, 7 of them are mentioning AI foundations. And actually, if we look at this video, the last one that they just posted, they show how you can use AI in order to really leverage the platform. As you can see, the user is using Adobe Firefly. It's prompting Adobe Firefly to generate a few different images. The user then chooses which picture to choose to take further. Once he chooses that picture, he takes that picture, he puts it into a video, into a generate video motion. So he generates a video, an actual video, using Firefly with the existing picture that was generated by Firefly to create this awesome video, as you can see here. And then from here, he takes that video, puts it into Adobe After Effects, and he also uses Adobe's After Effects generative AI as well as existing features in order to come to a conclusion, into a final solution that is easy. It has a helicopter that flies into this video, and honestly, it does show the effect of not just using AI as, you know, an easy, cheap solution to do something initially, but also how to use AI to really boost productivity, to make things much faster than you would normally do. And this is a 15-minute video. He does everything in 15 minutes, and it does show the power of AI when used correctly with a platform that already has all the capabilities needed. Now, in terms of valuation, in my opinion, there are 3 kind of scenarios. The first one is the base case, which I'm using the consensus, I'm using what the Wall Street expects, which is 9% revenue growth, and I'm also using 11% net income and free cash flow growth, because I do think that Adobe will continue to improve margins and also improve free cash flow conversion at a P ratio of 20, which is, you know, the average that we have seen roughly over the last 2-3 years. And as you can see, that means that margins will continue to increase from 29% to 32% by 2030, which I think is fair. And then for my base case, I'm assuming much less revenue growth as it continues to deteriorate. It goes to 5%, net income and free cash flow to 7%, and a P ratio of 15. And the bull case is a 12% revenue growth, which is due to, you know, AI becoming a catalyst, driving more revenue, more user growth, and even a bigger boost in net income and free cash flow growth as the company is able to generate more cash, more margins at a P ratio of 25, which would be fair under those assumptions. And with the base case at the current price, I see a very high margin of safety with the DCF method at an intrinsic value of $558 or 43% margin of safety. And the intrinsic value with the EPS method comes at $448, so it gives me a margin of safety of almost 30%. It's just slightly less than my target of safety of 50%, but it does speak volume of the upside from this point onwards based on what the actual value is if the assumptions were to be as said in the base case. Now, in my bear case scenario, which I am taking, in my opinion, bearish assumptions here, the intrinsic value with the DCF method comes at $471 and with the EPS method at $373. So even at my bear case scenario, there's still margin of safety, there's still upside with my bear case scenario. And that speaks volume because it does suggest that, even at a point where revenue and income and free cash flow growth deteriorates massively, almost halves from current levels, the company is still undervalued and has some margin of safety, and the risk reward here is actually higher. Now, for my bull case scenario, the DCF method brings an intrinsic value of $744 and with the EPS method at $608, which gives me a huge margin of safety of more than 50% with the DCF method and almost 50% with the EPS method. So even at the bull case scenario, which in my opinion is not far-fetched and could very much happen, there is a massive upside for this company. So in terms of what I'm doing next, where I think the stock goes from here, I think that the stock will probably stay at similar levels or even continue to suffer in the coming weeks. I think that Adobe will struggle with this narrative unless they show something else, unless fear goes away. And the only way that fear goes away is if Adobe consistently continues to do what they have been doing for the last few years, which is consistently beating estimates, consistently showing double-digit growth. And once they do that for 2, 3, 4 quarters in a row, those fears will completely go away. And that's when we'll see the highest upside, in my opinion, for Adobe. It's going to be a very long game, but I think it's the right game for Adobe. As always, thank you so much for watching. I hope you liked the video, and I'll see you guys in the next one.